Okay. Good morning, everyone. Thank you for joining us today for our Construction Market Outlook Forum. Today we have Richard Vermeulens, Senior Principal, myself, Blair Tennant, Principal, and we have a guest, Carter Jenkins, here today, Central Operations Manager with Amherst. We're going to dig into the residential market a little bit. I know probably everyone out there has a home they live in, and it's pretty interesting to hear what's going on in that market. Few housekeeping items. We're going to take questions via chat. We're going to have this information, the deck, the recording, a summary, all available on our website. We'll also email it to our list. Our forums will follow the quarter end. So 2023 Q4 will actually happen in February of 2024. So have a look out for that meeting invite. The agenda, we're going to walk you through our market outlook, talk to you a little bit of summaries from our quarterly report, and then Carter's going to take us through the residential market economics and some cost trends. I want to start today with reminding everyone where we are and what's been going on in the economy and why we've been seeing some crazy pricing. So this first line is the unemployment rate. And you can see here when the pandemic hit, unemployment shot through the roof. So I bring in another line here, which is the Federal Reserve assets. So this is essentially money supply that they inject into the economy that previously did not exist. So in the 2009 subprime mortgage crisis, you can see the unemployment shooting up. They printed $1 trillion. You go forward to 2020, unemployment shoots up $3 trillion in bond purchases and up to $5 trillion by the time they were finished before they got the unemployment. So you can see it worked. Unemployment shot up. And then as they injected money into the supply, it came down and to historical lows. But the magnitude is 5 times what they did in the subprime mortgage crisis. The next lever they had was interest rates. So that's the purple line here. Again, as they did in 2009, dropped the interest rates to zero to bring that unemployment rate down. Dropped it to zero here in 2020, brought the unemployment down. The catch is this new line here, which is PCE, which is the inflation rate that we've all heard of. Similar to CPI, just a little different. We don't need to get in that today. But you can see that's the consequence of that money supply and low interest rates. The escalation, it shoots up through the roof. We're hitting 5% per annum. So this red line here is when they switched gears and started pulling money out and raising interest rates. And you can see the escalation has leveled off. It started to actually decline. So this is the world we're in right now. Richard, do you want to add to that?
I think it's a very good graphic about the new normal. I've talked about this quite a bit in the past presentations. And what the new normal is that the Fed is empowered to look at unemployment and levels of employment and look at keeping prices stable. In order to maintain prices when everything was collapsing around, they needed to do those injections and they accomplished it. The hangover is to take some of that stuff back out. Like, how do you slow the economy down? And there is a lot of talk about we're going to get through this without a real recession, a full blown recession where growth is low and unemployment is high. So what I noticed in the data as we are coming out to that long expansion was that there were plateau periods. And you're seeing here the stock market prices, the New York Stock Exchange price levels, and that's an indicator where money's coming out of the system and prices went up and then they plateaued and they stayed that way. How long did they stay there until the next round of growth in price levels for assets? And that's what the key is right now. How long is this going to last? We can see that we're going forward across at the top of the page. We don't know how long it's going to last. We can see these previous episodes of growth recessions and how long they lasted. So here's this labor force. So the Fed's empowered to look at the labor force and looking back over a long period of time, and this gives us some insight how long those deep recessions went with respect to unemployment. And you can see that it's very short for this one. It barely made the radar before employment came back after the pandemic. So these actions are aggressive and they shorten these timelines and we hardly feel the pain. So here we're looking at the growth part of the growth recession with these horizontal lines, how long they lasted, 2011 through 14, and so on, where growth got below 2%, and how long was that? So the issue that we're facing now that was different from the growth recessions that we experienced from 2010 on through to date is that we did not have price inflation problems. In fact, inflation was below target through that time. We didn't have enough inflation, and that was part of the new normal. We got to get inflation to our target. It's below it. We got to get it above. But we got the opposite issue now. It's above, and we got to get it below. How long that lasts is the big question. And it likely will last a little bit longer than the previous growth recessions because those price levels are high. So it's all eyes are on how quickly the price levels in PCE, consumer prices, drop and how hard do we need to go. And right now, the Fed's staying put. They're not going up any further. They're watching things decline. Real interest rates are out there. And hopefully it works out for the best, but be prepared for this being a little bit longer. It's not going to be the sudden movements we saw with the onset of the pandemic.
Thank you, Richard. Bring you back to gross domestic product. Very similar. You can see the dips that Richard showed you in the past chart. We had this two negative quarters there at the pandemic beginning, and then the other at 2022. You can see the two negative quarters happening there. That was essentially when they started pulling money supply out and raising interest rates, right? So a lot of the market slowed down, anticipating a dental crash per se, but maybe we are headed for the soft landing because we continue to grow as an economy. Here's the job growth over the last this 40 years. And you can see this threshold around 150,000, 100,000 jobs. Every downturn we've seen is one you fall below that. And Richard showed you the percentage of the workforce. We have a growing workforce. So there, we need about 100,000 jobs a month just to continue with the growth in the workforce. So you can see we're still adding jobs, which is a great sign over here on the right, but it is declining. We're gradually every month that goes by, we're declining. Here we're supposed to be talking about Q3, but the October job numbers are out and it's at 150,000. So we're moving down, nothing to be panic about because construction is still growing. We've added 5% since the pandemic, so more construction going on in this country than ever before. However, it depends on where you are. So this is September of 2020 to take you back, a weather map we've created in-house. So blue is cold, red is hot, and we've got a few in between there. Basically, September 2020, economy, construction, everything on hold. We fast forward to 2021, a lot heating up. So you got a lot in the red, a bunch of orange, still average, above average in September. Move forward to 2022, it's really pushing to orange and red, heating up quite a bit. And here we are now, 2023. Quite a few blue areas, a lot of green and yellow, which is average to below average. The dots down on the bottom there, those are our major metros, the top 20 cities per construction labor. So the biggest construction markets in the country. You can see three of them are actually negative. So declining, and quite a few that are below average in growth rate right now. Here's just another way of looking at those. Texas, Massachusetts, still growing. If you're in those markets, we're in those markets. There's still a lot of upward pressure on pricing. However, I've highlighted down below Missouri and St. Louis. Recently, we just got some really aggressive bidding in that market. You can see the curve here, the blue and the decline in construction combined with the fears in the markets over what may happen with this quantitative tightening, I believe is introducing some favorable pricing for those owners. Same with steel. Here's structural steel. This is a unit rate we are reconciling down on most of our projects. We've seen a reduction from around $1,700 a ton down to almost $1,300 a ton. So that continues to roll down, helping pricing on a lot of projects. Another indicator we look towards is AIA billing. So this basically is how many design contracts are signed, and a rating of 50 means that they are growing. You're increasing in contracts. A rate below 50 means they're declining. And if you look for the last 12 months, pretty much every month has been flat or declining, mostly declining. A big drop down here since July. So 12 months of declining billings essentially means likely 12 months of declining construction volume to follow, right? So you have to design before you can build it. If we jump into the non-residential market, where most of this audience, I believe, works in, Carter, maybe some of his folks that are on are in the residential market, but the trends are very similar. We're going to see they're just out ahead of the curve. We're going to talk about that in a minute, but I see a flattening here, right? If you look across a lot of growth, but the last 5 to 6 months, we've gone pretty flat. If we look across other sectors, healthcare flattening to declining, manufacturing flattening, education flattening, commercial flattening, offices, I'm curious about what that number is, but we'll let that be for right now. Turner Construction, they have an index. What are they seeing? 18% pre-pandemic to now. The last 12 months, 6%, and they're pushing along at 1.2% a quarter right now. Mortenson, another that has a published index, 32% is what they've seen since pre-pandemic. 12 months, 2.9. So they've slowed down quite a bit relative to Turner. Then Q3, they're sitting at 1.3% in Q3. The economic data from Fred, St. Louis Fed, they're showing 29% increase from pre-pandemic, 12 months, 3.8%. And then interestingly, here's the first index that I've seen that's gone negative. So they've actually had a decline in pricing for their database. What's Vermeulens seen? Quickly, 23 to 28%. So it depends on where you are, how busy your market is. If you're in one of those red states, orange states, you're experiencing higher than normal escalation. If you're in maybe the Midwest, you're experiencing less than the 23%. But here, things to point out on this chart, the green line here is our index of construction costs again over the last 4 years. If you look down below, the red line on the slightly different slope is PCE and long-term inflation. What you can see is the volatility in construction is so much greater than the economy as a whole.
The lower line shows what we were talking about with respect to the Fed needing to hit its inflation target of 2%. There was a long period of time where they were under target and the economy was underperforming. Therefore, they created this new normal that said we are literally going to inflate and we are going to get to our target. So they're now getting above that 2% long term. And of course, they're going to come down and do everything they need to do to hit that again. And the relationship between non-residential construction and the overall economy is roughly times two. We've got a long term that's trending towards 4%, and the Fed's trending towards 2%. And that's the difference between a microeconomy and a macroeconomy.
Thanks for that, Richard. And I think we talk about this in our presentations, our lunch and learns quite a bit internally. But one of the reasons that the volatility exists in the construction market is generally competition, right? So there's a lot of movement that can be had within overhead and profit on a project. In a busy market, you're going to pay premiums for overhead and profit. In a slow market, the opposite happens, right? Whereas PCE is a measure of an hour labor or a gallon of gas, et cetera. It doesn't have the competition factor built in. So that's a big part of the volatility as well. Summarize things here for you. We've got 4 indices that we've looked at today, but to summarize, across the top, we've seen 18% with Turner, 32% with Mortenson, Vermeulens 23 on average, but up to 28 in certain markets, 18 to 30%, 32% range of what we've seen. Over the last 12 months, we've seen that trending down. So we've got 3% to 6%. Quarterly, we're all trending down below 6% per annum. We're sitting around 6% per annum. Federal Reserve sitting around, or the St. Louis Fed is saying -1, so actually declining. And Mortenson and Turner just under where we're at, maybe 5% per annum.
Yeah, soft landing is definitely what would lead to that 4 to 6% range. Like I said, roughly double what the Fed is targeting for consumer prices, right? 2 to 3% is what they're hoping for in 2024. Bidding contingency, we started the pandemic with recommendations in the 5 to 15% range. And we are starting to come into a position where very few of our projects are using bidding contingency. We're still suggesting a 0 to 5% range, depending on the region, depending on the project.
With that, thank you. That summarizes our market outlook. What we've got next is a look into the residential construction market. Carter Jenkins is a friend of mine who oversees, I think, over 40,000 homes that they own in their portfolio. And he's worked a lot in the supply chain management. And we're going to dig into what's going on with interest rates, investments, and where that market is. So, with that, I'll pass it over to Carter.
Thanks for the intro, Blair. So, my name is Carter Jenkins. I work for a company called Amherst Holdings. Mainly, what we do is we're everything single family rentals and then some. So, we're one of the largest players in the space. We have over 45,000 homes across 32 different markets, spanning pretty much the entirety of the US. Heavily focused in Atlanta, Florida, a lot of the South, the Sunshine, Smile States is where we are. And really, our main business model is we go in, we buy these homes either through private sales or off the MLS. And then we're going into these homes and renovating and bringing them up to modern standards. So most of the time, these are homes that are 30 to 40 years old and have been neglected for some time. And we're bringing them up into something that a family would be happy to live in and raise their kids in. And so normally we're going in, we're spending anywhere from $30,000 to $60,000 on these homes on average,
Wow.
doing really a full cosmetic renovation of these things, doing a lot of also the appliances, mechanicals, things like that, and getting these things up to our standard. With that, we're heavily involved in the supply chain space. That's where I come in. I'm on the supply chain team. So up until very recently was the lead analyst on the supply chain team. Now I oversee some of our central operations, but do a lot of the analytics and forecasting for the team still. So wanted to just kind of run down with you all what we've been seeing in kind of the macroeconomic space, and then diving into what we're seeing in just as of our industry. And then we've mitigated a lot of our costs over the course of the last year, 2 years. So really overall within the macro industries, it's not surprising when costs are up everywhere. Inflation's crazy. I think the last inflation report came out. Core inflation year over year was about 0.1%. Labor prices are still high. There's still labor shortages. None of that's news to anyone. Prices are going up, even though we're starting to see a lot of demand falling with that, though, with those high prices, which is kind of a contradictory statement there. But really within the housing market, there's not a lot moving right now. So on the new build side, most new construction has grinded to a halt because a lot of people were busting out of the rates. It was gangbusters over COVID when interest rates were at all-time lows and people had access to a lot of cash. They were upsizing their homes. They were building a ton, and there's huge backlogs built up. Ever since interest rates have climbed to be sky high, a lot of people are busting out of those. There's a lot of cancellations happening, and builders have really gone through their backlog. So there's not much backlogs left.
Does this apply to major developers? Are you focusing more on your onesie twosies, personals, small, that kind of stuff?
So this is kind of everyone. So right now, pretty much everyone's hurting. The only volume that is currently moving are the really big guys, the Lennar, the DH Hortons of the world. And the reason they're able to do that is no one's buying homes right now, whether it's on for new build construction or for private transfers within on the MLS. Homes aren't moving because 80% of all mortgages are locked in sub 5% right now, because everyone refinanced their mortgage when interest rates were at 2% and their payments are nothing. So no one's wanting to sell their current home and then go buy in an 8% rate. Their monthly payments are just insane. And so that's kind of created this lock on housing. So that's really what slowed down both the new build and just private sales. The only movement in the main market are the really big guys, like I said, the Lennars, the DR Hortons, things like that. And what they were able to do is they were able to leverage their size and actually go to the big banks and buy down interest rates. So they were able to say, hey, we're going to have 10,000 mortgages. We want to pool our money together and buy down the collective interest rates on these and mitigate some of the risk for you and pay this down. And they're able to actually provide their customers with rates around 5%, 5 to 6%. So beating where you could go out to whatever bank by several percentage points. And that 5% seems to be the magic number where homes are able to transact. People will trade out at 2.5 or 3% for a 5 where they're not willing to go to an 8.
So visually, you've now got large scale developers taking a chunk out of their margins to finance the sale of their backlog.
Exactly. And they're able to make up in volume what that offsetting cost is. So the big home builders are actually booming right now. They're making record profits, where your medium sized guys and your small guys are dying because they can't do that. So they can't sell their houses. So they're doing a similar thing to what I'll touch on. What we're doing is they're paying a premium to get that mortgage payment down to buy their volume. And then they're taking that volume and getting cost discounts with the trade base to kind of offset those costs. And that's similar to what we're doing.
So they're not just losing, they're just taking the hit all themselves. They're going back to a labor market, a supply market that's softening up, saying, okay, we don't like the fact that you're getting a 50% margin when ours has to cut down to this percent. So you're going to hurt too. We're going to negotiate that.
Exactly. That's exactly what's happening, especially during COVID when everything was so crazy. Prices were going through the roof, labor was through the roof, backlog schedules were through the roof. So people could really throw whatever number, or laborers could throw whatever number up there, and people were paying it just to get the job done because the margins of profits were insane. And so if you went in trying to negotiate down labor and these sort of bulk deals, they would laugh at you. They wouldn't even take your call because they had 100 calls coming in asking, saying that it will pay anything. Now that is softened, the entire labor pool is chasing a muchly reduced pool of demand. And so whoever has the consistent project workflow has the buying power amongst a fragmented trade base. So kind of transitioning that into single family rentals, the industry that we're in, very similar thing. We're using slightly different trade partners. Like I said, we're doing more cosmetic rentals, so it's a lot more mom and poppers and like full framing crews and things like that. So what we're seeing is the same thing. A lot of personal remodeling jobs have stopped. Over COVID, most people made the upgrades to their house they wanted to when they were stuck inside for 2 years. They already went and spent that money, did the upgrades they wanted to when they're staying at home, and they couldn't go spend that money anywhere else. So those project backlogs have died down, especially as American savings accounts have dwindled. With the economy opening back up, people are going out spending money, not saving like they used to. And a lot of people have been dipping into those savings to kind of stave off the crazy inflation we've seen over the last couple of years. So American savings accounts are much lower than what they had been previously. So that individual remodeling spend is way down. And a lot of the big SFR operators like us have also really slowed down during this time. The way the entire industry works is they're going and sourcing capital from abroad with large institutional investors. So people that are investing in whether it be social security funds or pension funds or things like that, where they have tens of millions, if not hundreds of millions of dollars, they're looking for a place to put that money. Those people are kind of sitting back and waiting. When you can go onto Robinhood Gold and earn 5.5% as an average Joe on your money on an annualized basis, when you have that kind of money, you can go and put it in with pretty much risk-free investments, earn 6-7% on that money. Take that money into an institutional investor like ourselves, where your rate of return, there's a lot of risk for not that much accretive gain compared to what it would have been before. So a lot of these big institutional investors are sitting back, waiting, seeing what's going to happen in the market. And so a lot of the big remodelers like us or our competitors, I've also seen their volumes drop over the course of last year. They're kind of waiting for interest rates to come back down to kind of turn that machine back on. So all that remodeling spend is also drastically reduced. So the trade base is getting hit from all fronts.
So price levels have to stay a little bit firm and not start to crater, because that could mean a rescue situation in house.
Correct. Yeah. And overall, we're not overly concerned with that. More so that the housing market is a lot more stable today than what it was. There's a lot of bad practices that were going on, very bad underwriting, bad lending practices that were happening in 2008. So there's a lot of lessons learned from that. So the housing industry isn't nearly as vulnerable as what it was back in 2008 that caused that crisis. So even though we have seen home values go down in quite a few markets across the country, actually, anywhere from 1 to 10%, in some markets like Austin being some of the biggest where they've gone down. Overall, the rent prices have stayed heavy. And since a lot of our thing is a buy and hold type of strategy where we're not selling them, if they dip temporarily, that's not going to kill anything. As long as the bigger risk is the occupancy, if we can't rent out or rent start decreasing, that's where it starts throwing the math a little more wonky.
Carter, the one thing that really was surprising to me when we talked the other weekend was that you're out there buying at discounts, right? So you're saying to
Right.
train like, hey, I need 100 air conditioners. What do you got? And they're just so happy to build their backlog that they're giving you great pricing. And in our market, the institutional market, we're still seeing the opposite, right? We aren't getting that yet. To me, it always comes down to how much people want the work, right? That
Yep.
dictates how much it's going to cost. But just can you talk a little bit on that?
For sure, yeah. And so that's kind of what it all builds up to. So I alluded to it earlier with what it's the same thing a lot of the big home builders are doing. So over the course of the last several years, no one was willing to negotiate price. Big manufacturers, sign incentive deals with them saying, hey, we'll use your water, your HVAC, your carpet, your LVP, whatever it may be, pretty much exclusively if we get guaranteed pricing, guaranteed product availability, rebates, things like that. Those deals were very hard to push through over the course of the last several years because they didn't need to. They had massive backlogs. Why would they agree to that for nothing? Same thing with on the labor side. So that's on the supplier side. Labor side, same thing. Even though it's a fragmented labor base, if you went down to try to push down pricing, they were going to laugh at you. So really what we've done over that course, we pooled large numbers of vendors to come out. So I'll break it down from the labor side first and then jump back into the supplier side like you talked about. So on the labor side over COVID, we built up a vendor base of over 4,000 vendors all across the country. So now that labor's softened, and like we talked, all the reasons that they're getting hit from different angles, they're willing to chase that demand. So they're willing to give volume discounts. So what we're able to do on our labor base is come and say, hey, we still have a constant stream of homes coming through the pipeline that need to be renovated. So we are still going out and buying homes. It is at a slower rate than what it used to be. We're waiting for it to scale, but there's still a constant flow of homes coming in. In addition, we have that built up portfolio of 45,000 homes. So those are homes that are on the platform that are there that already have happy families living within them that are constantly having their water heaters break, their HVAC breakdown, the dog chews at the door, whatever it may be. There's tons of repairs that are happening on those every day. So there's still a large volume of work that we're doing. And what we're able to do is we're able to go out and take that and say, hey, you might not know where your next job's coming from, but hey, we have all this work we can give you, and we're going to have this work for years to come. But if we're going to assign it to you, we're going to need some help on the pricing. And we're pretty much able to bring that pricing down that kind of really came up over COVID and with the inflation and get those preferential rates just due to the size of jobs that we have. So of all the trade categories that we track, we break everything we do down into probably about 15 trades or so. We either held constant in all of them or saw reductions year over year in pricing. The only one trade we saw go up in spending was our HVAC spending, and that was due to a regulatory change where we're having to go and change out from Tier 2 to Tier 3 in a lot of our homes. And so once again, if that wasn't there, we would have seen a decrease. So we're able to hold pricing constant while the rest of the market was going up, or actually able to go down and partner with some of our vendor partners and say, hey, this is a happy situation for both of us. You're going to have a ton of work going your way. You earn a little bit on each one. You're going to make a lot more money than you would not earning on any. And then we're going to get some of the better pricing on our end. So that economies of scale. Same thing on the supplier side. Suppliers didn't have really an interest in signing any of these deals, especially for a 2-3 year term length. It's the opposite now, where they're back in they've turned through their backlogs and they're going and looking for new opportunities. Depending on the industry, some are more willing to jump on it than others, but we have had a lot of success negotiating some of these deals in the last 12 months, which is really just going out and saying, hey, we're going to use you as our exclusive partner in, like I said, water heaters and HVAC, whatever it's going to be. And we're going to sell your products in tens of thousands of homes across the country. And then also, you're going to have all the maintenance on those. So if it's an HVAC unit we install and the coil goes out, well, we have to buy your replacement coil. And so there's a lot of business that we can promise them over the course of it, and then get those things like the rebates, the locked in pricing that holds for several years, bring that pricing down, and then guaranteed availability to protect us against if something like this happens again and there's a crazy supply chain constraint. If we have deals saying that we're your customer number one, we're going to have that product at the right time. If not, you're going to go source another product for it. Right. So that's really what we've been doing. Just as the market softens, whenever you have that big pool of jobs, it gives you kind of the negotiating power and in the relationship to go out and find deals that work for everyone.
So it might not be your end, but how do you arrange your company generally? How do you arrange labor to maintain and to do these building fix-ups as you go? And do you have any insight into how much more competitive it might be right now, whether inflation's flattened off and gone into reverse on any of that stuff, or do you have insight into that side?
Yeah, so how we manage a lot of our vendors partners is like I said, we have fragmented vendor network all across the country. And what we do whenever we moved on to standardize pricing as much as we can. So when we go out to a home, we're not going and having to get bids back and wait all this time for them to bid it out and then choose the best bid. Basically, we go out and we're partnering with a lot of smaller vendors. There's a lot of mom and pops, stuff like that, or small companies with a couple hundred employees that run this stuff. And we're going and say, hey, if you want to work for us, here's our price book. In this market, we're paying X amount of square foot for LVP. We're paying X amount of square foot for tile. We're paying X amount for cabinets. And we've gone in and really broken down the labor, the materials, the sundries, and done all the math on what this should cost and understand what a fair overhead and profit margin would be for them. And basically, we build this out in the markets and say, hey, this is our rate. This is what we're willing to pay. And then we go out and we sign on these vendors, and they're signing on. They're saying, hey, we're going to do the work at this price. Obviously, there's a one-off solution or one-off issue. There's obviously always those on the project. They can go and submit bids for those. We'll get bids from a couple of vendors and bring it back. So that's kind of how we generally manage it. So it's easier to control that pricing where you don't have runaway pricing, because we have a line item based pricing, allows us to underwrite our assets. We're buying them at a lot higher degree of accuracy. Then we just kind of follow the market and go from there. So what we were able to do is you do lose some vendors when you're pushing down on pricing. We had 4,000 vendors that were onboarded and were active. When we started coming down and pushing on pricing, hey, you might lose some of those, but that's fine. There's other vendors that are willing to take that price. And so as our volumes come down, we don't need all 4,000 of those vendor partners. And so we're able to put some pressure, find the ones that are willing to take the best price. That kind of becomes our standard. And then it just kind of monitor it from there. We start having a lot of pushback on a price, or we'll track commodities too. So if we know our lumber's going way up, or we're going to have to raise the price for decking in those markets, price per square foot. So it's really feedback from our internal field construction staff, feedback from our vendors, commodity tracking. And then anytime we do a price increase or we have a request for one, that'll kick it off with our procurement team. And we go do a full deep dive of it and do that same math of, hey, what is labor for this trade? Partner with the U.S. Bureau of Labor Statistics or some of the other sites that we have, see what labor is doing. We'll go in and actually break out the material. Do we have an incentive agreement with this material? Do we know the price, or where are they procuring it from? We'll go run that price and then add in that overhead markup and really arrive at that price. And so we're more price setters than price takers in this market.
Right. Part of that, I think that ties into the Ken Pinto, I guess, analogy or concept that we talked about, is how much is the milk, right? And just to bring it back to our listeners here, generally institutional owners, designers, engineers, etc. But the principles still apply, right? So at some point, these large institutions will likely have their buying power back, like you have, right? And like right now, we're seeing it happen with natural gas generators, right? We got 3 bids in the last month, and they're all running $1,200 a kW. And I apologize for those that don't follow generator prices every day, but $1,200. Double, exactly.
Okay.
And then what we just had on the job the other week is there's another one that came in at half. The bid came back in where they used to be. And so what we're really pushing our contractors for and our owners for is like, dig down. What's in that number? What are the bells and whistles? What can you do to negotiate that in addition to the market? So I think that ties to how much is the milk. So I don't know if you want to just expand on that.
Perfect. That's exactly what we're doing, Blair. So the idea of how much of the milk is, you go to the grocery store and you get your full bill. You check out all your items. They say, all right, your total is $150. And you say, oh, how much is the milk? And they, hey, your bill's $150. Same way in construction, you get a bid back for a project saying, hey, this project's going to be $100,000. Well, how much is this piece of it? And most of the time, they're not going to be able to tell you. And that's dumb. We should be able to know what we're paying for each individual item, and that's how we add it up to that total. So that's really the principle we try to take at our company, is we're going down, we're doing that math on the back end. Either we make them supply it, if they can't, we're going to go and do it ourselves. So we're breaking it down to the individual line item level, and whether we're installing LVP, we're painting a wall, painting an exterior wall, like each individual trade. We have over 1,000 different unique line item pricing, price ups for every single different aspect of a house, and then different prices for each one of the 32 markets that we're in. And we have these same formulas that all play into it. And like you said, then you dive into, hey, what is the average labor rate in this market? What is the actual price of material? What are the relevant sundries involved in it? What is a fair operating margin? And that's how much we're going to pay for it, instead of just getting that total price. And a lot of times, that's how you get to the bottom of it. If you're getting a crazy bid back on some of those one-offs that we have, we'll ask that of our vendor partners. We're not just going to accept the bid that says, hey, $10,000 to do this. Like, no, we need an itemized bid to see what we're paying for it. And so that's a great tool to use in construction. And at least we found very successful in our industry to dive in and not just take this bundled cost, but unbundle it down to its individual components. And even within one of those line items, like installing tile, there's a lot of different things that go into that. There's a material itself, there's the tile spacers, there's a grout, there's all those things. Those are broken down in our calculation. Even if it's napkin math, you can get close in some of those. Just understanding all the cost components that go into it. And then when you take that to the negotiating table and say, hey, We just ran all this. You had Bureau labor statistic price on labor rates. Here's all these different things. Where am I off this? Like, how are you coming in at double? Maybe there's something we missed and we were wrong. But a lot of times they don't have an answer for it. And we work to a place where we can then find a price that works for everyone.
Wow, we're just doing that a minute ago with Josh, he's the contractor. Well, this is the number. It's $20 million for mechanical and plumbing. Well, how many plumbing fixtures are in there? Well, I can't tell you. Well, let's start digging a little.
Yeah, so it is a little bit easier on our end because we're dealing with a large number of smaller projects. And so it's harder to get lost in some of those numbers when you're, I know y'all building massive buildings where it's easier to kind of hide some of those numbers in those big plans. So it's a lot harder for people to get away with that in our industry. But the principle, like you said, it applies to any industry, no matter how big or how small the project is.
Yeah.
And we find it goes both ways too, though, right? Like we sometimes will get a number that's half of what we think it is, or the generator, for example, right? Like we have a job and they get another number that's half, and like we still have to raise our hand and say, hey, everyone else is paying twice as much. Like, is everything like is the milk accounted for in that number? Like, in the way we do it is we build with detail, right? So we have a database that's fully detailed, and so we won't just carry a cost per square foot for plumbing, right? Like Richard said, we're gonna, even if it's not drawn yet, if it's a block diagram, we're gonna say you got this many fixtures, you got this much waste pipe, this much plumbing or copper pipe, and then there's a basis for it. And if the contractor is double that or half that, then we have something to kind of gauge the appropriateness of the number and set the right one. Again, it's not, the contractors aren't always high, oddly, most of the time, but not always.
It
No.
depends. We're so
You're right.
used to it now, right?
Yeah.
It's been 3 years almost of things taking off.
Yeah.
So
We're seeing, I think, a couple in the Midwest, right, that are really, we're starting to see some really good pricing, right? So it could be that those institutions there are starting to get that buying power back. But we're still here. I'm in San Antonio, and we're still seeing pressure the opposite way, right? Where the contractors, especially on the technical trade, like the MEP side of things, that they're just like, we got more work than we need. We're record year after record year. And so if you've got a really complicated project over there, I don't
well, so,
necessarily
yeah,
need that work, right?
yeah. So yeah, part of the impetus for us non-residential types with similarly sophisticated data is to the residential market is huge and it grew enormously through this boom, which means labor pulled into that, which affected construction and other markets throughout the economy. So when residential levels starts to taper off, as you're indicating, that means there's a whole flow of prospective workers and workers who are in the residential market to be looking for jobs. You were mentioning your level of demand has contracted, and now there's a surplus of supply. And if they don't come to your price, then they're out of that work. The question to us on the non-residential side is, hey, if non-residential's doing well, then that at least the workers and perhaps even some of the contractors will have availability within those markets. So that's the level we're looking at it on this $1.4 trillion question of where the workers are and where they can go, and whether, in spite of non-residential continuing to climb, get the net benefit of a greater pool of labor coming into it as the heat, the extreme heat comes off of residential. Is that in your planning models? Do you feel like the pandemic has caused a new paradigm shift where people are going to work from home? People are going to want a single family home. They're not wanting to commute anymore. They're going to add on an office. That the residential market is, in spite of this leveling off, is looking good for you medium to long term.
The residential market is as strong as it's been in ages. There's no doubt about that. The pandemic really put an emphasis on that. While remote work might not be, there's that big come back to the office push. There's a lot of hybrid that's left. People are spending more time in their home. They have those home offices. They've learned to cook in their homes and do a lot more things in their homes that maybe they weren't doing before. There's still a shortage of millions of homes in America. There's a very large number of people that want to buy homes right now that can't buy homes. It's kind of twofold. So the real estate market has slowed down due to interest rates, and that's intentional. That's what the Fed's trying to do. When the Fed's raising interest rates, they're trying to cool down the economy. Like that's their number one growth. They're trying to stop growth, and they're able to do that very easily in our industry because that's what everything hinges on are those interest rates. So demand's being tampered on purpose, and they're trying to drive it down, but it's still there. Basically, they're just waiting for those interest rates to come back down where people can afford them. There is a shortage of housing.
There is a shortage.
Yeah, there's a lot of that. And in addition, within our market, we're sitting in a very strong place. There's more renters out there than ever. A lot of people want those bigger homes since they're staying at home where apartments don't really work for them. One of the biggest population that we have right now is obviously the baby boomers, but coming up behind them, the millennials, they're getting to that age where they're having families, they're having multiple kids, they're no longer in that apartment scene. And that's going to be a huge number of homes that need to be ready and be there. We see that very good. And then in our market specifically, whether it be rentals, there's a very large subset of people that can't afford homes right now. And we're able to provide access to neighborhoods and areas of opportunities and education, all sorts of things that a family could never live in or could never buy a home in. But really what we're doing, we're providing value to them to be able to go live, raising a family in a neighborhood that they couldn't afford to buy a home in. So the rental demand is higher than ever with housing pricing being as high as it is. And
do you see that continuing to grow, that the flexibility that your model affords where people don't have to commit or can't afford yet to commit? Because one of the long-term things, the problem is backs up to how much land is made available in most of the markets across North America for development. Canada, it's terrible. The North might also across the US be terrible, depending on California is terrible. But there are places where, yeah, you can build and land is affordable.
You hit a super interesting topic. So a lot of what we do, we work with, I've only really touched on our single family, we're repair and remodeling. And so we're going in and we're buying homes that already exist. We have an arm where we are doing new builds and we are building that supply and we're doing full build to rent communities. Startup, don't have a whole lot of homes. I think we've only done about 500 homes there so far. But that's another really cool wing we just opened alluding to that is, hey, where's this land going to come from to build homes? Is a new startup that we've launched called Studio Build. We just opened our first factory out in Cuero, Texas earlier this year. So this is super cool. So this is fully modular homes and they're not trailer homes. They're not temporary housing. They're built to full IRC code, the exact stick frame, every code that if you were to go build a house in Austin, Texas, it has to live up to every single one of those building codes for a full normal house. So these things are real stick frame. And they're built in sections and you can stack them on top of each other and set them up in all these cool ways and truck them wherever. And so just as you mentioned, you're getting further and further away from the city center with these things. The plots of land where you can go and build homes are narrowing down. And for the economies of scale to work on a home, you really can't just go to an empty lot and build a one-off home. It's going to cost you $1 million minimum to go and get a concrete truck there and a framing crew there and all these things. The economies of scale only work out in track home production. That's how it works out. So the framing crew can go to 1, 2, 3, 4 homes. The concrete can do 1, 2, 3, 4. The carpenter can go to 1, 2, 3, 4. That's the only way they can make it work. Pricing wise, one-off homes don't work. And so what this model does is there's tens of millions of lots very close into city centers all across the country that are very cheap, but that you can't go and build a home on them. Or there already is a home on there that is a very old and decrepit home that's falling apart, that's filled with lead paint and asbestos and all these other things before our modern day codes that you can't really renovate and really just needs to be knocked down and something else is put there. So we're able to go buy lots for very cheap close to the city center, go throw a pad on it for cheap, connect it into the grid, and then go set that home on site and have a real great looking product that you wouldn't be able to tell the difference from just a normal production home that is going to last as long as a normal home would because it's built to that. And it's permanently fastened to that thing, to that foundation. And we're able to unlock that part of the housing market too. So we're creating housing for families that there's really no other way to do it. So another really cool thing to be able to do, and you're able to get that economy to scale because you're building it on a factory. You can take in a truckload of cabinets, a truckload of lumber and trusses, a truckload of shingles, and then you have all those economies of scale that you have in a factory of an assembly line and being able to build one after another. You ship it out, boom, you drop it on site with a crane, and you got a full house there. So that's kind of what you're talking about. Hey, what is long-term supply like?
Yeah.
Not only are we operating off the existing supply, we're going and making our own supply where supply hasn't existed.
Great. Scatter tract housing.
Yep.
Got it.
So I think, Rich, I don't know if you have anything else. I do have a kind of a closing one for Carter. And then I don't know, I guess if you have the time, but the final question, which is I'm asked every day what things cost, but they also I'm asked what will they cost, right? What are they going to cost a year from now, 2 years from now? And every time we have a speaker on that's in, construction, generally that's what I want to know. What do you see down the road? And you're in a different market, but the principles are the same, right? You've got buying power right now, and prices will slow down for our owners once they get the buying power back. So just for you, what are your companies? What's your outlook in particular with respect to cost?
Yeah, in the short term, I think we continue to think either seeing holding pricing or able to bring them down through some of our agreements. I think a lot of the low hanging fruit we've taken advantage of, but as demand still the market is still softening, there's room for incremental gains, at least staving off inflation. So in our book, even holding costs steady, as a massive when inflation's at 4.5% year over year right now. So looking in the short term, short to medium term, 1 to 2 years, I think holding constant in most trade categories, possibly reductions for us depending on how we can leverage our vendor partners and deals we can sign with the manufacturers. I think long term, once it starts to pick back up, the idea is we have these agreements in place and we're doing the work now to keep our pricing locked in when we're signing these 3-year deals now. We're signing these deals with our labor partners and kind of buying in while it's cheaper. Because as it turns back on, as interest rates come down, which they will, they're not going to stay up here forever. Once the Fed starts lowering interest rates, demand's going to pick back up. Home building is going to kick back up. Renovations are going to kick back up. Our acquisition pace is going to kick back up. And when that happens, that buying power will decrease a little bit. It's not going to go as crazy as what it did in COVID. But to sum it up, I think short, medium term, holding our pricing, looking for price reductions where possible. And then in the long term, there's year over year growth. I think we're going to see some price increases in the long term. But I would be shocked if we saw anything more than just what keeping up with inflation would be.
So our long-term res is about 4%. And that, because it excludes kind of warehousing type spaces for the most part, our data doesn't include that. What is your long-term? What were you seeing pre-pandemic in terms of long-term inflation?
We've actually gone down and got our costs about in line with what they were a little bit over pre-pandemic levels. So we were able to kind of walk back the track on that all the way that big when we got to drug up the hill. During that piece of increase, we were able to fight a lot of that back off. So it's a lot of the decreases that we've seen is kind of bringing us back down to reality. Long term, I really think as we peg our, like we're breaking it down and doing the math there. So we're really trying to peg it to inflation. If we can keep pace with inflation, we're doing good. So I think long-term inflation outlook is probably going to be about 3%, 4%. That's probably the realm that we're looking at in the next couple of years.
Okay, we do have one question that has been submitted. And it says, in Texas, we are starting to see an increase in bidders in all categories except MEP. Material costs are starting to stabilize. However, labor costs are going up higher than usual. Is this the same in residential? Carter, I believe that one's for you.
Yeah, happy to take that one. We are seeing that in kind of the same way in the residential side, although we're staving it off from actually hitting our pocketbooks. And what I mean by that is, I alluded to it earlier, the pool demand has shrunk. And so people are willing to go out and chase that demand a little bit more. So on a one-off project, labor is high. Materials have come down a little bit more than labor has. Labor has been much more sticky, obviously, just with the cost of living and the inflation we've seen over the last several years. But really what's happened is since we have that backlog pool of demand, speaking, from us, where we have those 45,000 homes that are constantly requiring maintenance, and we are still, able to promise those as all those new homes we bring through the pipeline and have volume there, where we're going out and trading out price decreases for them or holding prices constant to be able to have that continued volume. So really, while their labor rates might be going up, what's happening is probably their overhead and profit is coming down a little bit as those margins grew a lot over COVID, where they were setting them at astronomical levels because they had 15 people coming and asking them for a job a day, and they could only do one, so they could set whatever price they wanted to. So while the core labor rates are going up, the overall prices we're seeing on the labor side are holding relatively constant. I think it's really more that margin side that's coming down.
Thank you. How do we compare to the construction market in Canada and Europe? Is this an opportune time for more international work?
Rich, you want to try that one, Rich?
Well, we're North America, and essentially the weather map, I think, tells the story about what's happening in Canada relatively. The Toronto area is a hot market. Montreal area is pretty cool, pretty reasonable. So essentially, those markets are quite similar and quite integrated with the overall North American outlook. So can't speak to overseas.
Okay, thank you. This is a sort of a off the cuff question. Will Vermeulens be at the COAA in Orlando next week? I get Blair.
No, we're not actually going to be there. It'd be great. We could look into it.
Yes, we're not, but we have been for the last little while. We've made a couple of those, and certainly it is on the agenda to stay current with the COAA. Thank you.
All right, thank you very much. I don't have any additional questions at this time.
All right. Well, thanks everyone for joining us. Thank you, Carter, for your time. And we will chat with y'all in February. Happy holidays. Take care.